Hey everybody, welcome to your Mortgage Market Week in Review for the week of Monday, June 5th, 2023. MBS were completely flat early in the morning today. Bonds extended Friday selling pressure at the start of the overnight, with both 10-year yields and longer-run Fed rate expectations lurching higher in Asia. The European session had its own version of the same theme, but with more focus on the longer end of the yield curve, with German bunds rising 3 basis points in short order after opening nearly 3 basis points higher. Then we got the S&P Global PMI, which came in at 54.9 on a 55.1 forecast, 53.6 previously. ISM Non-Manufacturing came in at 50.3 on a 52.2 forecast, 51.9 previously, and factory orders came in light at 0.4 versus a 0.8 forecast and was 0.9 previously. The big news the market was processing was over the weekend OPEC Plus met and announced no changes to its planned oil production cuts for the rest of this year. Saudi Arabia, the world's leading exporter of oil, also announced it would voluntarily reduce its output to 9 million barrels per day, down from 10 million. We also got regulators that are planning to increase capital requirements for big banks up to 20% in response to the regional banking crisis that took down Silicon Valley Bank and others. Even if banks that rely primarily on fee income will see an increase, the plan is to characterize fee income as an operational risk. I didn't see anything in the news about regarding mortgages. However, everything has a trickle-down effect. Investor purchases of homes fell almost 50% in the first quarter compared to a year ago. This is a record decline in terms of percentages and occurs as asking rents are beginning to level out or even decline in some markets while borrowing costs are surging. Plus, they pretty much bought up everything that they probably want to hold, so it also has to do with their holding so much inventory. At the end of the day, bonds remained in selling mode after Friday's jobs report. 10-year yields rose in Asia and Europe before hitting the highest levels of the day before the domestic session opened and balanced out. A glut of corporate bond issuance created additional headwinds, but they were no match for the weaker ISM Services data. This was good enough to get both Treasuries and MBS back to pretty much unchanged levels on the day. MBS closed up 3 basis points, stocks lost 9 points, 10-year lost 1 basis point. So at the 5.5 at 99.86 is putting us just above this flat red line, which is the Fibonacci R1 retracement at 99.845. If it can stay above that and keep progressing, we have a next resistance all the way up at 100.285. It's about 3/8 above that. If we drop back below, there is a chance it could run all the way down to 99 1/8.